welcome to LCR's continuing series called Worldview. It's a webinar-based program focusing on families going global. Worldview is committed to bringing interesting topics, industry experts, and hopefully we provide an educational platform for addressing questions, interests, and really the concerns of our clients and their families. We have some really great speakers today, and we'll get to those introductions in a few minutes. LCR Capital's leadership is excited to have content experts sharing what they know and what they expect, which I think is even more important than what they know. We hope you find you'll be informed and energized to kind of explore more topics of what we cover today and ask some questions of our panelists. Now, one of the things that we do to save your vision is that I will be reading the legal disclaimers today, so I won't hurt anyone's eyesight this morning. So I'll get the disclaimers out of the way and then we can get going. LCR Wealth is a registered investment advisor located in Westport, Connecticut. LCR Wealth may only transact business in those states in which it is registered or qualifies for an exemption or exclusion from registration and requirements. This presentation is limited to the dissemination of general information regarding LCR Wealth and investment advisory services. Accordingly, the information in this presentation should not be construed in any manner whatsoever as a substitute for personalized individual advice from LCR Wealth. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Any client examples are hypothetical and used to demonstrate a concept. Past performance is not indicative of future performance. Therefore, no current or prospective client should assume that future performance or any specific investment strategy, including investments and/or investment strategies recommended by LCR Wealth, or product referenced directly or indirectly in this presentation, will be profitable. Different types of investments involve varying degrees of risk, and there can be no assurance that any specific investment or investment strategy will be suitable for a client or prospective client's investment portfolio. Additionally, LCR Capital Partners, LLC is an advisory firm, but the information presented today is no way should be considered legal advice. If anyone has questions of a legal context, we recommend the participants seek competent legal advice. Okay, great. Now that we've got that out of the way, I think we're ready to start our webinar and get back to our scheduled event. My name is Greg Sweeney, and I am the Chief Client Officer here at LCR Capital, and I'll be the moderator for today's webinar. Today's event is a discussion on the financial markets and trends with LCR Wealth President Tom Garvey and Mike McGlone of Bloomberg Intelligence. First, I'd like to introduce our external guest speaker today, Mike McGlone. Mike is a senior commodity strategist for Bloomberg Intelligence and specializes in the broad investable commodity markets. Mr. McGlone joined Bloomberg in 2016 with over 25 years of futures and commodity trading and investing experience, beginning at the Chicago Board of Trade. Prior to joining Bloomberg, he was head of U.S. research at ETF Securities, and prior to ETF Securities, Mr. McGlone headed the commodity business at S&P Indices. Mr. McGlone has an MBA from DePaul University in Chicago and a Bachelor's of Science and Arts degrees from Illinois State University. He is a CFA chartered holder and has earned a financial risk manager designation. So today we plan to cover commodities as well as crypto and how these topics, given the current economic environment, can maybe be better demystified and maybe better understood. At the end of the webinar, we will have a question and answer session. So participants can get answers to pressing items on their mind. One of the things that is important is you'll see at the bottom of your webinar list, there is a Q&A button, not to be confused with the chat button, but the Q&A button is where we're going to take the questions that we're going to present after the discussion with Tom and Mike that we'll get to all of you. And so with that, let's get started. Welcome, Mike and Tom, and look forward to a really robust discussion here this morning. Tom, if you don't mind, I'm going to kick off this with a question for Mike. Mike, what is it about this area of the market that you've spent so many years in that drew you to it in the first place, and that keeps you excited and interested that you've been in it for so many years?
First, thank you for having me, Greg and Tom. Tom and I go way back, have raised our kids together in Connecticut. And I apologize for having to make everybody suffer through that bio. So simple, I can say macro strategist at Bloomberg. It took a while to get here. The key thing I like about what I do here in Bloomberg Intelligence when Mike Bloomberg started this group is have my own views. I'm not biased, buy side or sell side. Been there, done that, been a trader. So here I just write what I think's right. My goal is to get markets right. And what I find compelling now is this is the most significant macroeconomic environment I've ever seen. And it's very bad for risk assets. So I have to put that disclaimer out right away. Remember, these are my views. But what got me here is initially just when I first started studying macroeconomics as a 17-year-old, it grabbed me. I'm like, I got to get into this space. So here I am, the macro strategist. And just to put a long story short, my nickname lately has been McGlone. And I like to point out it's not so much on my price of commodities and assets, it's because I take it as a compliment. Because I'm so bullish on human nature, which is why I'm bearish commodities. Now we can point that kind of stuff out, and I can mention a dozen books I've read on the subject and things. But this is it's just a great passion to get paid to try to act like I know stuff.
That's so funny, Mike. If I describe Mike, he's humble, but he's confident in his own opinions, which is the best combination ever. I want to personally thank Mike for being on here. As he said, we've known each other a long time. We really didn't talk shop too much, so we actually get to talk shop today, which is fun. And, I'm going to start out with some wider ranging questions, and then we can get a little bit more specific. But, in general, as a wealth manager, we spend a lot of time in equities and fixed income. And to be honest, commodities are there, but they are a sideline player for most asset allocations, most discussions with clients. And truthfully, after watching you and reading a great deal over the years, I find out that they can tell us a lot about the equity and fixed income market if we're just wise enough to listen. Yeah. So I think the first obvious question is, given the situation we're in and given your precursor there, what are commodities telling us about the health of global markets?
Bad bear market at the moment. So let's look at facts. And then here's what I like to point out. We all, facts are more powerful than opinions. Let's point out facts. The Bloomberg Commodity Index, the spot index, is the most widely tracked index. On a year-over-year basis, it's down 26%. There's only one major time in history exceeded that. That was around 40% during the great financial crisis. It's being read lower by crude oil, and copper just broke down, industrial metals. It's showing us a significant deflationary reset in process right now. That's a fact. Now, maybe it's not going to happen. Maybe we'll get lucky. Typically for these things to stop and end, you need a long and variable lag from a period of significant Federal Reserve easing. Just a few weeks ago, they tightened, and they're still tightening. They're still jawboning. So what I see now is set up from a commodity standpoint is what's showing up in producer price index. The producer price index at 2% or so right now is dropping at the fastest pace in history. Yeah, admittedly, we only have 75 years of data, but it went from 18% last year to around 2% now. During the financial crisis, it dropped at a less of a velocity than that. So we are plunging into a deflationary recession right now from commodity standpoint. And the key thing is the Federal Reserve is still tightening. So I'd like to point out is we've never had these two combinations. The key thing I want to point out about the producer price index, it basically has a 2 beta to CPI. It's basically if CPI is up 5%, PPI is up 10% typically, and it's a good leading, it's a high beta measure of inflation. So from a commodity standpoint, things are collapsing globally. Crude oil price, people were calling for 150 last year. I've been bearish the whole time. I was wrong initially. It's $70 right now. And there's a good reason it's $70 because that organic demand pull isn't there, and the ability to create more with less increases every single day, which is good for some of the equities that you track. But from an underlying commodity standpoint, it's just, these are facts. This is what's happening in commodities. So the key thing I'll kind of narrow down to, Tom, is so commodities are collapsing. that organic demand pool is not there. We're not seeing a sign of it ever picking up anytime soon because this potential U.S. tilting towards a recession, and I can get into that a little bit. And key thing that's really struck me recently was what's happened with copper. I like to go with copper, particularly because I expect you and your clients have a little more of an equity bias. The price of copper on the screen right now is $2.70 or so a pound. It has been trading almost tick for tick with the S&P 500 since 2015. If you take the S&P 500, divide by 1,000, it's been roughly the price of copper. They're all hovering around 4,000 recently and broke down. So maybe copper's going to diverge. Maybe this is going to change. But right now it's indicating that all assets should go lower. And this was my call early in the year when copper bounced up 12%. It's a classic case of a bear market rally. Now it's back down 2% or so in the year. So that's the big picture for commodities. And the key thing I ask myself every day is what stops this current trajectory of prices going down? And I'll end with this. Historically needs some kind of organic demand pull on a global basis. Where are we going to get that organic demand pull? Typically takes some form of pretty significant liquidity injection. And the only two countries injecting liquidity right now, the two main ones are China and Japan, right? Because they're getting pressured lower. So back to you.
So, it's interesting what you said about China. I just got briefed by Blackstone maybe a week ago about China and what they see going on there. And it was pretty bad, quite honestly. They believe that they have the ability to switch on domestic demand, and it's just not happening. And so they're actually right now thinking about stimulus, which is fascinating. But it doesn't seem to me, again, listening to what you just said and listening to what they were saying, that that's going to be enough. And, I couldn't agree with you any more about what the Fed is doing. And it's fascinating that parts of the market, like commodities, are in retreat, and yet inflation is stubborn. And the inflation that we see, of course, are wages, cost of housing. Those don't seem to be going anywhere, but all the other indicators are pretty strong, to your point, that we're going into a recession. So, given all of that, and given the worldwide demand and production of EVs, it would seem from the outside looking in that rare earth metals should be doing slightly better than, say, your general commodities. And I do want to acknowledge that a lot of copper goes into these things as well. So it's not just rare earth metals. People seem to think that cars just run on rare earth metals and no other metals, not being the case. But, what is your opinion about, are they in the exact same boat? Are they doing slightly better? I just love to get your overview on that.
So I appreciate you going there, Tom, because I enjoyed the last, I think it was about 6 years, I bought my first EV, 2014, parking in that Westport train station right in front and charging for free for about 6 years. Because I think his name was Smith, the major person who was involved at zoning in Westport, said, yeah, we don't care yet. We're not, we had panels and didn't charge me. It was just a wonderful situation. But that vehicle was awesome. And it's 2014. So someone's 10 years old. We're seeing in right now one of the biggest retooling of auto manufacturers in history globally. And they're all trying to catch up with Tesla. Tesla's sales next year, I hear, are going to surpass BMW. I remember they were only 50,000 a year. Now they're over 1 million. And why? And they've now only considering advertising now because it's a superior product, superior technology, just a matter of time that gets better. So it does mean demand for rare earths. It does mean demand for copper. I'm bullish copper in a big picture, but I fully expect it to drop a third before it goes up 3x in maybe the next 10 years. The key thing to remember about that space and rare earths is it struck me last week when I was in New York at a metals conference, and they had 3 gentlemen from the Department of Energy presenting, and they talked about in the US, they funded some with I guess they do joint partnerships with some US companies to extract rare earths from coal with coal extract and mining of coal, which is obviously not considered politically correct, but they were really shocked with the results. They're able to get decent amount of cost-effective rare earths from coal. So obviously we all know China is one of the main areas that holds rare earths. I don't really focus on rare earths too much because they're not really the macro, but it's the equities that you probably get involved in. But that's the key thing I want to point out as a commodity strategist is the ability, and we spoke about this a little bit early on the call, for human beings to create more with less on a daily basis is increasing exponentially. And so that's why commodity prices will continue to go down over time. And I can mention two books, The Price of Tomorrow by Jeff Booth. Now I can repeat that later. He became a friend of mine. He just pointed out how everything is deflationary over time. I'm reading this book right now called Super Abundance. I forget the author, but that is, anytime you get price to pick up and the need, humans will find ways to do it, particularly with technology advancing so fast. So I'll give you one example of that. I owned a farm in Indiana. And in the 70s, there was a thing called the Great Grain Robbery by the Soviet Union, where they bought a bunch of grain from the US and pumped up prices. But the average yield in corn and per acre, we owned a farm, was about 90 bushels of corn per acre. Now it's 185. It's doubled in just 50 years. How'd that happen? Only because of technology, better growing techniques, and actually we use less fertilizer than we did in the 80s. Better seeds, drones, everything. That technology is improving exponentially. And I think that's a key thing to always keep in mind from an investor standpoint. If you're thinking of investing in commodities, other than the metals, actual metals index, like the Bloomberg All Metals Index, which I encourage our team to create, you're typically better off in producers. Like there's a thing called the XLE. I just look at the macro. The XLE, probably I'm sure some of your clients know about this. It's the ETF. And I don't push any type of products, but I like to overlay things like that with the underlying Bloomberg like energy index that tracks the futures. And these producers almost always outperform. You know what's the difference? Metals. So if you look at things like gold, you cannot create more gold cost effectively like you can every day with fossil fuels. I mean, I'm from a farm. A lot of that corn we produce went for ethanol. And that shows up in things like if you measure the price of gold over the GDX. GDX will underperform over time. You need to be specific about the miners that you pick. So I think that's the thing I like to bring out. Remember, I don't give investment advice. I like to point out trends. And that's the key thing, I think, in the macro to remember about commodities. So I'm very bearish things like now about crude oil. I've been bearish way too early. I think crude oil about $70 is going to go to 40 or 50. The cost of production in the US. That's a rule in commodities. You almost always go to the marginal cost of production. And one thing that just happened is natural gas. Now you're seeing lags. You mentioned that earlier. You're seeing lags in lagging inflation measures that measure 12-month basis. I've published on if you look at 120 months, we've had a blip and they're going down fast. If you look at leading measures, they're collapsing. So here's the dichotomy we're in right now. And then I'll go back to, I just remember what you mentioned. We're in that pace right now. The Fed is focused on lagging measures like personal consumption expenditures, employment cost indices. They will remain sticky. Our economist, Anna Wong, who's our chief economist, said they will remain sticky and the Fed's going to keep doing that. But the forward-looking measures are collapsing. So that's what I'll tilt back to crude oil. Crude oil will go to its cost of production, just a question of time. And in the US, the average cost of production is about $50 a barrel. Now it's done this many times, and I want to kind of tilt towards what's already happened. That's a quote. That's my outlook from over a year ago, and I got beat up for it. But you know, I was wrong and early, but now it's turning out that way. It's already happened in natural gas. Natural gas, the number one measure in this country for heat, electricity, and fertilizer, which means food, bumped up from about price of 2 to 10 last year. It's back down to 2. 2 has been the average cost of production in the US, and it's the same price it first traded in 1990. That's called human ingenuity to create more with less. And hopefully our restrictions in this country is not too much that we can still create more. And that's what's happening to me in commodities. But I like to differentiate. There's a big difference from things like metals, which you mentioned. I always look at metals indexes long-term. Holding physical metals is good. You can store them on your body. They're easy to hold, and they'll typically outperform the producers of those metals. But when you look at things like energy and agriculture, the producers typically outperform.
Yeah, that's fascinating. Offline, I want to have a long conversation about that because I've looked at the producers versus the commodity itself, and I see the trends you're talking about, but I have to be honest, I don't fully understand them, but I totally agree. So that brings me to two questions. One question with two different commodities. The first one is, you know, we saw the Saudis cut production, which set everybody, you know, off on a tangent. And its effect, it seemed like they were actually precedent, because the effect was not to raise prices except for like a week, and then it went right back down. So I clearly they saw the lack of consumption, and they were trying to get ahead of it. And then you have, of course, the Russian invasion of Ukraine, and we've heard over and over again through the news that is just doing a job on soybeans and wheat and things of that nature. And yet, you just made the comment that they're still tracking down. So, how do you calculate those things when you're looking and you're doing your projections? It seems to me that they should be more than a blip, but we really just haven't seen it yet.
So that's the key thing I will mention and note right now, being completely neutral. I'm glad you pointed out a few of the key things I nailed and got right, because I get so many things wrong. And then people will remind you of the things you get right and the things you get wrong. And sometimes you learn things about their personality. My goal is just to get it right. And here's facts. Virtually every time in history Saudis have cut like that, it's part of a bear market. It's part of it's signal of a bear market, because they see what's happening. The goal of OPEC is to boost the price of crude oil. And what has that done? It's helped produce U.S. shale, and it's helping becoming their own worst enemy. They know it, they see it. I've written about it for years. And when we had that pump recently, I so enjoyed writing. Like, when I hear some of the sell side analysts who have a vested interest in being right with the price going up, I love to print on the terminal right away. Nope, sell. I can't say that directly, but I can imply it. I think prices crude oil is going down. So that one I really enjoyed. So that's a fact. They see what's happening globally. They have to cut supply because they realize they might see crude oil easily below $40. It's typically what happens in recessions. That's a fact I fully expect to happen. So those are just one of those little nuances I love about being an ex-pit trader. One times when you're running money and being an ex-hedge fund guy, and your P&L's dependent on you pushing that button, buy or sell, oftentimes the thing you read and see from the consensus, you do the opposite. I think that was a quote from Benjamin Disraeli was, if it's a consensus, it typically doesn't happen. If people don't believe it, it typically does. That's what's happening now. And I enjoy just so writing about that in crude oil. When I pointed out that crude oil last year our data goes back to only 1899. And my editors kept saying, Mike, you sure you have the wrong data? I said, no, we have data to 1899 in crude oil. It never spiked on a 2-year basis as much as it did in 22. Last year, and every single time it's done that, it helps stimulate recession. It shuts off demand and squash and kicks in supply. I was in the trading pits in 1990. The same thing happened when Saddam Hussein invaded Kuwait. I didn't say Iraq because it was one person who did that. Crude oil went from 20 to 40. And remember, with my clients, we kind of got off sides first, and then it went back down to 20. It took 14 years to get back above 40. And what happened since? The U.S. was back then the #1 importer, demand pool of crude oil on the planet. Now the U.S. is a net exporter, the largest exporter of LNG, the largest producer of crude oil on the planet. And I just enjoyed writing a piece recently that President Biden is a maestro of crude oil trading, because he crushed it. I mean, nothing political, but when he started selling to SPR, I wrote a comment like he was selling to a situation called backwardation. And that's the essence of inventory management. When he sold the Strategic Petroleum Reserve, he was selling prices at the highest level ever. And just on a management standpoint, if I'm running that business, running inventory, I'd be buying back some futures on paper at a discount instantly. And on paper, you have the same amount, but he still hasn't bought back. So my net pointed out, just on gross level, he netted $20 billion, and he still hasn't covered that short. So I'm like, the key thing is we don't need an SPR in this country anymore, because if you conclude US and Canada, this is how things have changed. And I don't want to go on a tangent too much, but I just want to point out where things have gone. Back the last time we had basically on a daily basis, US and Canada production of liquid fuels. And I have to say liquid fuels because we have 14% of our unleaded gas now comes from ethanol. I used to own a farm. I have a bit of a bias there. On a daily basis, there's a net surplus of 4 million barrels a day if you include US and Canada liquid fuel production minus consumption. When we were at the last crisis, it was the opposite. And I like to say there's a current trajectory that's going straight up, but that's just of production exceeding consumption. And that's why I'm so bullish US and producers and things that's so bearish commodities and so bearish inflation. And that's just the lessons. If you look at a commodity index going back 200 years, they almost always go down, and we replace things like tallow and greasy wool and stuff we just don't need anymore.
I haven't
But I'm
heard
getting
those
on
in a long
tangent
time.
there. Yeah, but so that's, yeah, well, they as I ran commodity indices at S&P, so that's the key thing I want to kind of, I guess, go to is these, what you mentioned were lessons of history, and it's oftentimes what you'll hear and see. It's not the proper way to focus and invest. Now, I'm not saying I'm perfect. I get things wrong, but I just love pushing back on these widely watched narratives. So I'll end with this. One thing I really enjoy is when people say inventories are low, prices should go up. Historically, it's complete opposite. Prices of commodities, housing, and everything almost always peak when inventories are low. And that was a key thing I pointed out last year about crude oil. Inventories were very low, commodities peaked. That's a current case I'm hearing about housing in Florida and around the country is, oh, inventories are low and prices should go up. It's the opposite. When people say inventories are low and prices should go up, sell. That's just the lessons of history and lessons. That's a fact of how markets work in commodities, and housing is one of them.
Fascinating. Okay, well, that's great. I'm going to switch gears a little bit into everybody's favorite either horror show or sci-fi show called crypto. I don't know, depending upon if you invested in it, it might be a horror show and it might be sci-fi, because I literally had the son of a client ask me if I could hand him a Bitcoin one day. You can't make this thing up, right? So tell us about the current state of the crypto markets, and in relation to Gensler and the SEC seemingly cracking down in every way possible on the industry and the participants here, at least the ones registered in the US.
So the key thing I think I want to start with on that, Tom, is the number one thing to remember about cryptos is it's a rapidly advancing technology. And those of us who've seen these before, I came from the trading pits. I remember the first day I walked in the Chicago Board of Trade in 1988, I looked around and said, this is going to be replaced by technology. And poof, it took 20 years, 30 years, but poof, it's gone. What cryptos are is a fact I will point out first that most people don't know. And I love pointing this out to people who know businesses, is the number one traded crypto on the planet is the US dollar. Dollar tokens. It's not Bitcoin and it's Ethereum. It's tokens that allow the transaction of dollars instantly, virtually zero cost, on a global scale like that. And so here's the thing that'll hit home for you in Connecticut. Good friend of mine, Eduardo Abreu, you might know him from St. Francis. Sure, we know him from Weston. He works for MasterCard now in Miami. He's head of crypto for LATAM America. Eduardo's a friend. I got to meet him here. I got to meet him in Weston. We used to commute out of Westport together. That position did not exist 2 years ago. Why? Because MasterCard knows what's happening. If they do not do something with the ability for people to be able to transact money and not have an intermediary like them taking 2% in every trade, they've got to adopt. What happened with Blockbuster? What happened with Sears? I mean, these things just, we know how this works. So that is a key thing. I see Eduardo here all the time, but that's a key factor to point out about what's going on to crypto. That's the technology. I look at it, it's similar to futures. I was in the trading pits in the 80s. I remember the guys in New York, this was in Chicago, would get so upset when the futures were moving their markets. I'm like, well, sorry, but this is just a liquid place to go. And then we saw ETFs, 1990. What did ETFs do and futures do for mitigation of risk and for financialization of assets? Cryptos are doing the same. So that's the macro for cryptos. Yes, the US is pushing back in regulation right now. I don't know exactly where that's going to go. And I fully expect it's going to work out like Churchill said, is, we'll come to the right conclusion after exhausting all options. Gensler is going to be gone in 2 years. I fully expect we're going to have a switch over in like we normally do in this country in recessions, a switch over in leadership with the incumbents. But the key thing I want to point out about prices right now is Bitcoin has become, let's start with there, has become one of the leading indicators for risk assets. There is no, I point this out all the time, there is no more significant 24/7 trading vehicle ever on the planet where everybody in the world can transact on Saturday morning or Sunday night and it's always trading without an intermediary. That's just never existed. But also then there's the fundamentals of what Bitcoin is. It's becoming global digital collateral in the world going that way. That's the fact. What stops that? Nothing can really stop that unless there's some kind of mess up in the technology. But from a regulation standpoint, there's not much you can do except unless you ban the internet globally. That's not happening. The key thing I like to point about Bitcoin, from a commodity standpoint, it has definable diminishing supply, supply going down, and low and increasing early days of adoption going up. Price must go up over time unless the rules of economics no longer apply. The key thing right now, like the point is, I think that that's the macro. Over time, I fully expect Bitcoin to get to 100,000, but it could get to 10,000 first. And I say that only because I fully expect that we're going to have a classic, normal bear market in a recession in risk assets. And Bitcoin is still, cryptos, I should point out, are the riskiest of assets. Bitcoin is just the least risky crypto. So my base case is that, again, this is my view, is that the S&P 500 at 4 right now, 4,000, is going to drop to 3. 50% peak to trial, normal recession. Copper is kind of signaling that. Deflation signaling, and the Federal Reserve jawbone is clearly saying, don't fight the Fed. And we all know those are rules of liquidity. If that happens, which I expect to do, cryptos were going to go down too. Just Bitcoin will probably, I fully expect it might make a new low, and then we need to get out of that. That's my base case right now. If I'm wrong and the stock market just magically starts recovering again, despite all this, long and variable lags from the most significant hiking in ever, then cryptos will probably outperform, the fastest horse in the race. So I'll tilt towards this. I'll end with, that's Bitcoin, global digital collateral, and then there's this thing called Ethereum. I'll just focus on those two. Ethereum is making possible the tokenization of all assets, homes. The dollar is the #1 token trader right now. The US dollar tokens, like I said, the most widely traded. Ethereum makes that possible. It's the technology that MasterCard and Visa are saying, we better catch up or we're going to be pushed out of here. And it's also doing things like, I'll end with this. There was this NFT week event in Miami a week ago. I was there with MasterCard. I remember they're big Fortune 500 company. And it's allowing something that people never been able to do before. And that's to be able to monetize their intellectual property without an intermediary. Now, early days, massive speculation. I fully say so much speculation in crypto still. You got to purge it. We all saw that in internet stocks up to 2000. I mean, I remember trading some of those. My rule is always sell half it when it goes double. So I fully expect we're going to have more purging of the speculation, then it's going to go back to the technology being revolutionary.
That's fascinating. Yeah, we do a ton of business in India. And one of the amazing things about the Indian economy is the government has instituted frictionless payments between people. And from everything I've heard, and I'm not an expert on it, but from all the folks that we talked to over there, is MasterCard and Visa missed out. That Modi and the government came to them first. They said, look, we have to make our 3%. And they basically built the system without them. And so now even the smallest little businesses can send money back and forth with them. And it actually helped the government bring a lot of money from the black into the white. So I think you're completely true there. And there's probably no better example than India, which is a huge thriving economy that you just don't see, MasterCard and Visa and, a lot, especially business to business. You still see it with people, and especially Americans that go over there. But business to business, they've figured that out. So it's, like you said, that is a super fast evolving marketplace. And the margins that the big banks used to make are disappearing, as we speak. So like I said, it would make sense that it's also going to South America. It sounds like we'll be the least because we have those folks the most entrenched.
Yeah. Well, I appreciate you mentioned India. I've heard your typical rickshaw driver now does and takes all payments on his phone. No cash.
Yep. Oh, it's amazing. And, like anything else, a lot of times the countries that are moving fast are leaping the first, quote unquote, first world countries in technology and things. It's fascinating to see what's over there. The last thing I want to follow up on crypto is I have probably read 2 or 3 articles over the last 5 years. I don't know what sort of momentum's behind this, but it seems like it would make sense that the dollar goes digital from the government perspective, that they actually issue a digital dollar. It's fascinating that Ethereum is already doing it, but it sounds like dollar denominated. But what would the effect be if, a major country like the United States created a digital dollar for everybody to use, how would that affect the other markets or
It's
the
done.
other players?
It's already happened. And Tom, I appreciate this subject. I wrote about it starting a few years ago when everybody was worried about China doing a CBDC and taking over the world they want. It's the opposite. They are scrambling to catch up. That's what's happening organically on a global basis. The world organically has gone for the dollar through tokens in cryptos. So, and I've heard this a lot from my colleagues. I was in Hong Kong in 2018. I can't remember, I arrived right after the typhoon. It was all before the riots. And all my colleagues said, the mainland this, the mainland this. And everybody says, you know, for the first time in history, we can get access through Tether. It's a controversial token, the dollar, through our phones. We've never been able to do that. The flight of money I hear coming out of my colleagues in China, out of China, is hard to measure because it's hard to do it. But I think that's the key thing to point out is that allows the surveillance state to surveil completely. And that's, we have laws and rules about this in this country, but tokens are different. So I think that's what's unique to point out is the world's gone for the dollar organically through tokens. And there was this Lummis Gillibrand bill came out recently, I think it was over a year ago, bipartisan, female, I mean, win-win. And then of course, FTX collapsed and we're having problems right now. But I think I like to say we're not dumb enough to mess this up. We don't need a CBDC in this country. We just need to regulate these tokens like money markets, like banks, like primary dealers, which I worked at for a good portion of my career, and let free markets reign, and the dollar's crushing it globally. So this is one thing I really enjoyed. It's just when it happens organically like this, the signal is awesome. I have a colleague, Audrey Shield-Freeman, and it's one thing I love, is based in London, who's our FX strategist, is at BI. We're not competing for business. We're all just trying to write the best research without bias, and pointed out she was a little bit sketching the dollar a few years ago. And I pointed out, do you see what's happening with cryptos? The whole world went for a dollar. She turned bullish, and then we had that big rally. And so to me, this is part of the thing to remember of the strength of the dollar. When you hear about de-dollarization, and think, yes, of course, there's a war going on, and the nefarious and the characters are trying to get away from dollar. But there is indications from cryptos there's no better currency on the planet. And I like to call them crypto dollars. There's these things called stable coins. You've heard that quote in Congress. Sure. Typically, they are stable coins. I mean, so they are crypto dollars. The advent of euro dollars came out of the Cold War and people trying to get access to the dollar. The U.S. didn't really want it, so they went to foreign banks. It's happening through this new technology. The whole planet wants access outside of their melting currencies. May have a few exceptions on the planet, maybe Swissy. I mean, if you look at the yuan, it's basically pegged to the dollar. Mm-hmm. And then, of course, in Miami, I love, you get the sense here, all the currencies are basically melting. It's just a matter of time. It's all one access to something, and it's the dollar. But it's happened organically. And as far as, I hope our government doesn't mess it up, but just properly regulating crypto dollars, like we did euro dollars by trading futures on the CME, in which I used to trade, is a way to do it, I think. And just acknowledge that, thank you, world. You want the buck? We'll just say, make sure we don't mess it up.
It's interesting. I was introduced to stable coins from one of the top mergers and acquisitions guys at JP Morgan. And they were explaining to me that one of the deals they were working on, they were buying a European country, that 50% of the exchange was done with stable coin, and that it reduced the price because, no one takes a piece of it, converting it. It reduced the price $26 million. By using stablecoin. And then, right after that, I said, okay, you're going to have to explain everything about stablecoin because that sounds fascinating. Now, of course, JP Morgan lost some of that money because they would have been doing the FX on it, but but they realized that this is where things were going, and they had to get a lot of stablecoins for this deal. Apparently, you can't just print them up. But
I think that's a great example. I'm glad you mentioned that's classic incumbents versus the new technology. And okay, you're going to push back on it so long, and then at some point, if you do, someone else is going to come in there and take your spot.
Yep. So why don't we open it up to questions and see what our audience thinks. Thank you very much for answering my questions. It was fascinating, and I'll hand it back to Greg.
Thanks, Tom. Mike, fantastic. I could listen to this all day. This is wonderful information, and I'm sure our participants are really excited about what you're talking about. So what I've got, I have a couple of questions. I'll start off with one that both John Baker and myself came up with, and kind of goes back to that question where you said, you had a farm in Indiana and and that, things have changed so much with technology and all of those. Do you anticipate that artificial intelligence will begin to impact commodities and things that in some certain way? And what would that be? Or how would you think that would happen?
Well, I'm glad you asked there, because every day that goes by, I'm trying to learn more about it. I look at artificial intelligence. To me, it's like, I remember hearing about it when I was an undergrad in the 80s. My roommate was a big tech guy. And it took 40 years, right, to finally kick. And now we're getting into that suddenly stage. But I look at it as, okay, am I going to react to it like when my son, when we were in Westport and Weston, Connecticut 10 years ago, told me about Bitcoin. He was I think a sophomore at UConn. And I said, it's silly and internet money. I'm trying not to do that this time, but I don't think it's a big thing for commodities. My sense it's mostly for back office. Here's one good example. I was at an ETF conference recently in Miami. My good colleague who runs a lot of ETFs said, he had one client, he had one underling, one of his employees was having issues with emails. He went through ChatGPT, helped completely improve his emails to clients. So I think that's one good positive, but I don't know. It's one of those things though, okay, it's a rapidly advancing technology. I got to learn everything I can. But as far as actual prices of commodities, it's just, to me, it's part of what's happening everywhere. I like to look at, we mentioned farming. There's things like, I learned from a thing called exact shot technology from John Deere. This is not artificial intelligence, maybe it's somewhat related, I bet it is, but what exact shot does is just when we invented plows, and what we've been doing in history is taking people away from manual labor. What it does when you plant that seed, it plants the seed and shoots in exactly the amount of fertilizer you need right in that spot. It plants just as fast, and if it uses 60% less fertilizer. Yet you get just as much production. So I don't know and that's why I'm kind of still, I have to admit, I'm a bit just deer in the headlights with artificial intelligence. I just got to learn as much as I can. But what I did is I got on ChatGPT about 5 months ago when it first came out. You know who told me about it? It was a professor, a senior person at Miami-Dade College. All the students were using it. And I tried to find out, okay, is this going to ruin my job? And it made me feel better about my position, because everything I went in there for, what I do for a living, make predictions on markets, which is make you lose your hair, made me feel more confident that it was for me, it was good. And I was going to write about it. It wasn't even worth writing about, but it's for different areas. And here we're trying to keep up as much as possible, see what can it do to enhance what we do here in Bloomberg Intelligence.
Terrific, great. Here's the first question that we had from one of the participants. What is the forecast on housing/real estate prices in the US? And I don't know if that also includes commercial real estate or not, but that's
down hard. So here's a fact of history. We've never had, on a year-over-year basis, the FHFA housing market index, the Case-Shiller index, go up as much as it did to the peak in 2022. The lessons of boom and bust. I just read that book a few years ago. The lessons of pumps and booms in history, and the back of liquidity is dumping at the fastest pace in history. So I have to admit, this is what they call me McGlone. I think we're going to have a correction worthy of the rally based on the history, unless the rules of booms and busts in history since the beginning of mankind no longer apply. And we've had the biggest liquidity pump in history. You saw Home Depot's earnings yesterday, just getting started. I mean, who did not enhance and lock in a mortgage and just build and buy? Now, we all know what's happening with commercial. There's no hope there, at least for now. I don't know how that's going to work its way out. And I think it's just early days of those bankruptcies and credit contraction. These are just facts. The credit contraction is dropping fast. We all know what's happening with mortgage applications collapsing. Today, permits came out. Housing permits was one of the first thing that really got me bearish in 2007 and 8. On an annual basis, housing permits are dropping 2%. The last time we did that, the Fed had just pivoted. It was 2006-7. It just pivoted from the tightening, started easing in September 7th. The fact is they're still tightening. So the facts of the normal booms and busts of history and liquidity and housing and stock markets and everything, that we should have a severe economic reset. I say that is, maybe it'll be different this time, but I have to warn people. It's my job. And I like to say, if there's a hurricane company coming in, I don't warn people, I'm remiss and I feel guilty. So I don't see any upside in the north. So we have to, first of all, this recession is coming. And I fully expect, what I enjoyed about, I met with David Alteg 2 weeks ago, and he's the Atlanta Fed. He's one of Atlanta Fed governors in Miami. And he pointed out how, yeah, we fully expect a soft landing. When I pointed out to him that PPI is dropping at the fastest pace in history, and that to me leads me to believe the Fed's gone too far. He said, there's people at the Fed who agree with you, but that's, I think, the problem is they're focusing on inflation that's going to be the most transitory in history. You see that from commodities, and they're tightening into a recession. So the key thing is it's consensus that we're going to get a soft landing. So I look at that as the optionality, as I used to structure positions for clients and do it for myself, is the VIG there is, okay, we get a soft landing, it's priced in, big deal. The VIG is to structure trades that price for something like a severe recession. And I think worse than the 2008 crisis. Why? Because what was the foundation for this? The biggest pump in liquidity is going away. We're just trickling down from now. We've had some government programs, government stimulus lately, still trickling away. And there's a fact I'll leave with you with is it's a fact that unemployment is like the lowest in 50 years or so, 3.2%. But it's a fact that every time unemployment's gone up, we've had a recession. It's a stated goal of the Fed to increase unemployment. So that's what I see is the boom is busting. Commodities are busting hard. They're early leading indicators, and housing is just going to be part of that trickle down. The question I ask is what gets us out of that? Typically aggressive Federal Reserve easing.
Terrific, great. The next question that we have, it might be a combination for both Mike and Tom. And the question's a bit very focused, so I'll let you guys decide how you want to answer it. In terms of potential new portfolio investments for Brazilians moving to the US, when you're looking at the next 5 to 10 years, what presents the best safety in domestic opportunities, even given geopolitical issues and the USD losing its historic monopoly? What do you see as, things that moving from Brazil to the United States, what kind of things are, what they're looking for is a place to put your money? Also, given that, we have a pretty high U.S. fiscal debt.
Tom, you first on that one. I think.
Well, so the first thing I would say is if you look at U.S. markets historically over any 10-year period of time, you're generally going to do okay. Now, the only caveat to that is if you literally come in at the beginning of that cycle and you're at the highest of the markets, then it usually takes you 2 or 3 years to go down, 2 or 3 years to 4 years to come back. And at 10 years, you're probably doing okay, but you haven't made any money. And we've had a couple of instances like that based on timing. But in general, when you look at the U.S. markets, the safest places to be are S&P 500. I literally have a client who has held the S&P index at Vanguard for, I think it's 47 years at this point. And if you saw the performance through all of the different events that have happened, including, 2008, including the dot-com bubble, all those type of things, it's doing really well. In fact, we don't ever want to sell it because we'd have to pay taxes on it. So, you're always going to be fine over time. Time is the element that nobody gives enough consideration to in investing. Mike made a couple of comments about being early or not being right on something. The fact is that nobody is. The fact is that if you look at the underlying set of circumstances like Mike has been describing, what you have is likelihoods. You don't have a schedule where these things happen, where all of a sudden the market coalesces around the idea that things are overvalued or undervalued. It's just not how it works. So, right now, I think, I tend to agree with Mike that things are on a downtrod. It's not a rocket scientist to say to yourself, well, gee, the Fed is raising rates and pulling liquidity out of the market at the fastest rate that we've ever seen. Like, I don't know anybody who looks into that forecast and says things are going to be rosy. But if you're coming to the United States, I think very simply, if you're going to buy into the U.S. equity markets, the S&P is one of the safer places to be. Inside that, growth is and technology. We are on early days of where tech is going. We just talked about AI. Microsoft has gotten a huge bump this year because of AI. NVIDIA, all the chips were getting crushed, and all of a sudden NVIDIA is up 60% year to date. Well, how is that? Well, their chip is in most AI things. So there's always going to be places where you can take advantage of it. Sometimes you just wait out bad markets and you're happy to be even or slightly down. Other times you can take advantage of a wave, which everybody did the last 11 years, where anybody who built an asset allocation model was patting themselves on the back saying, look at the performance. I mean, let's face it, almost anybody could have done well with the Fed easing interest rates at 0 and inflation at near, at 1%. So there are plenty of places in the United States, especially when you're saying 5 to 10 years, that I think you would do well. I think, Mike made a comment about the housing markets. Buying a house right now is terrifying because interest rates are higher than they were and the valuations are incredibly high. We see that here. Post-COVID, Connecticut is off the charts. It's up 35%. How does that hold if the entire market goes down? Probably pretty unlikely. So, fixed income, there are some places you can do okay there. Also, as an asset manager, we look internationally. There's opportunities internationally. There's people that won't be affected as much as we are with what the Fed is doing. And the last part about the debt should be more concerning to everybody, both domestically and globally. And unfortunately, it takes a political will to deal with that. And I currently don't see that right now. Mike?
So I appreciate that. Makes a lot of sense. One thing about what you mentioned for Brazil, it hits home here. I mean, half our office is Brazilian. Our condo is Brazilian. I mean, this is Miami, and they come here for a safe haven. The key things I want to point out is facts I'm concerned about any U.S. market, certainly U.S. stock market initially, and that is before the Fed started its tightening cycle, the U.S. stock market reached the highest ever versus GDP. The U.S. stock market reached the highest ever exponentially versus the rest of the world. MSCI ex-US. You can take S&P 500 minus S&P MSCI ex-US. Gina Martin Adams, our equity strategist, taught me that one. The highest ever versus housing, and the highest ever versus sales. So I look at it as, okay, we're just due for an overdue period of underperformance in U.S. stock market. And that's just fact based on what I see. And as Tom said, the last 10 years have been wonderful. Every time you got 20%, the Fed was there. They said they're cutting that umbilical cord. That's over. So it's going to be organic. I think it's going to be more choosing your sectors, that you guys do that better. But to me, I look at it as right now, just a little while ago, that U.S. government 2-year note was a 5 bid in terms of yield. Now it's 4 bid in terms of yield. I fully expect it's going to drop down to 2. I say there's times in when you're supposed to just hunker down in good old government T-bills and bonds, and I think that's it, and gold. And I think we're in that period for now. I think those assets will be some of the best performers for the next couple of years. Once we get through the recession, and then I fully expect everything else will be at a discount. You can overweight the other way, but that's my outlook right now.
Okay. Appears that those were new question just popped up. Okay, let me grab this one. It was a thank you from saying you providing a lot of great information, which is very, very true. So one last I'll throw out there the question. Mike, you had mentioned that, there's some certain things that, where's this pending recession going to go, right? And could you name a couple of perfect storm things that happen to make it go really bad and a perfect storm that it makes it as light as could be?
The bottom line for it to be light is it'd be like 1994. I mean, that's when I first came to New York in 93 as a bond trader. We had a decent, pretty significant tightening cycle, and then things stabilized and we had the rest of that rally in the stock market. So number one indicator would be if you need that stock market to hang in there. But typically it takes significant easing. That's why I look at all the lessons of history as this is the big one. I've been calling it the biggest reset of our lifetimes. And I started saying that a year ago, and every day that goes by, I see more and more inklings that way. So the number one way to really make this not happen is that stock market has to stay stable, not just do a normal 50% peak to trough like it did the last 2 recessions. To not do that, to not have a recession would really, you just look at measures from the yield curve. I look at the New York Fed yield curve. It's the highest indication probability of recession since 1982. And so something wonderful has to happen that's really unexpected. And I don't, maybe we can get some good peace in that hot war in Europe. Maybe we can solve this budget crisis right away. I fully expect when they do, we're going to have a short, a risk asset rally. But right now, I don't see what it is until typically it takes liquidity. Number one thing is liquidity, and the Fed is still taking that away. You look at bank deposits; they're clearly showing credit contraction. You look at money supply, lowest ever. I mean, negative. It was the highest ever. Just that stuff for me is like, this is classic. I'll end with this. Ben Bernanke wrote the essays on the Great Depression, and he pointed out it was really the big thing was global contraction of money supply. It's clearly happening right now. That money supply, that liquidity has to reverse typically for us not to get this major contraction in risk assets.
Terrific.
You know, one observation on that is you watch the current government and you see their response to the small banking crisis that we had. And I say small almost sarcastically, considering that SVB was what, the 14th largest bank in the United States or something. So there's nothing small about what happened, but they were pretty quick to come in and intervene. And there's a lot of, you know, Mike, you can tell me what you think about this, but I've told clients this: in the last 10 years, I've never talked more about politics versus the markets than I have the previous 15 years I was in this. And to be fair, I wish it wasn't the case, because everybody feels very strongly in one or the other. And it's always difficult to get to the underlying foundations of what we're talking about here, which is dealing with a client's portfolio, working on risk, trying to get them the best return. But it seems to me that a lot of people have your opinion, Mike, but they throw in the caveat that they believe there'll be massive government intervention, not only because this is what they've seen so far with what they did with the banks, but also in 2 years, we're going to go into an election cycle. And, you know, other than 1 year ever in the US, did the incumbent win during a down economic situation. And by the way, that was this current president, to be fair.
Yeah.
So it would seem to me that, you know, all of the data that you've talked about is fairly unassailable, except the fact that the government can print money, create liquidity, and push it off at least for a little while. And that's why we have a debt the size that we do, because many administrations have been doing that on one form or fashion. So, you know, what do you think about their ability to do that over the next year as they start seeing these things come home?
So I think the easing we've seen from the Fed will never happen again, because of the lessons of too much easing and inflation. Never, the rest of our lifetimes. Maybe, you know, a couple generations from now, or if we get some, you know, some not so good leaders in our Federal Reserve. But bottom line right now here is anybody who's, I think, bullish risk assets is fighting the Fed. It's the stated goal of the Fed is to basically reduce the ability for people to buy stuff. They didn't say it that way. Jim Bianco did. And I look at it as until I see that liquidity pump, which might come, I fully expect to be able to buy risk assets at a discount. And I just look at it as times of underweight and overweight. In the last 10 years was a wonderful period of overweight. And now they're giving me 4% and 2, you know, thank you, US government. It's like you're supposed to say thank you.
I agree with that. We have more cash with our clients sitting in money markets that's getting 4.95 than I've had in 25 years.
And the good thing is you have plausible deniability now. If that doesn't work out, blame me. I'm happy to take that risk.
No, I'm probably going to end today thanking you once again for coming on. This was great. Really appreciate your time. Like I said, you know, you can see Mike on almost any financial media outlet. I've seen him on many. Our 4 screens in the office often have him up there. So I tell him I see him more than he ever sees me.
Yeah, well, just an FYI, I've been doing a lot of Bloomberg Canada TV. Have not been doing a lot of Bloomberg TV. I think it's because they don't like my doom and gloom view. And I was like, hey, I'm just honest, man. And just checking in a year. It's always 12 months ahead. I always got to think 12 months ahead, minimum.
Well, gentlemen, thank you both so much for today's webinar. And we learned a great deal. And for those of you that are participants, if you are a client of LCR, always remember for kind of synopsis of these things, we keep them on the client portal that you can always go into. And if you have lost that password, please let us know and we'll get you back in there. And for those of you that are current clients of LCR, we have newsletters that come out often that we have this kind of material in there. So, one of the things that, we'd like to do with Worldview is we try to have it very diverse and, unique perspectives on different areas of the world. And so if you feel like anyone on this call of the attendees if you have a friend or a colleague or that you think might be interested in these kinds of topics and things that we cover with Worldview, please let us know. We can get you, come to a client service group, my group, or come to the regional commercial team leaders and let us know. We can get them into our CRM and get these kinds of things in front of more and more people all the time. I think it's just fascinating and wonderful. So gentlemen, thank you very, very much. And this concludes our webinar for the day.